Money can buy happiness. Stay tuned to Wealth on the Move, the podcast, to find out why I think this way and other lessons that I've extracted from a 23-year career in the wealth management business. Your life journey doesn't stand still, and neither should your wealth. Welcome to Wealth on the Move, the podcast. Welcome back to another episode of Wealth on the Move, the podcast. I'm your host, Will Hoffman, founder and president of Hoffman Wealth Management. And today I'm by myself. I'm going to spit some brilliance and see where this goes and how we can do. But this has been a big week, volatile week, a couple things to celebrate, a couple things that made me think. This week I celebrated 23 years in the wealth management space, 23 long, fun years. This is a get-to job. I get to do this. I get to work with a great team. I get to work with amazing clients, get to do a business that I love with people that I love. And for me, it's been 23 years of lessons and happiness and progress and growth. And as I say about a lot of things, we are just getting started. And it's kind of bizarre to say that after 23 years, but unfortunately, I'm 47 years old and had a couple things go on this week that made me realize my own mortality. Lost a friend who I hadn't seen in a very, very long time, a friend of mine from college, and it makes you think a lot about what you're doing, realize your own mortality. And it's somebody that I hadn't stayed in good enough touch with, and not for any good reason, just, we're with our families, we're in our businesses, and everybody is focused on, what they're doing, and we should be. But made me think a lot about my business, my family, my friends, and wanted to come today with something that I wanted to look back over the last 23 years and talk about the 23 lessons that I've learned from wealth management and give you all some insight, nothing too deep, because 23 is a long time. 23 is a long list. And I don't want to harp on each one because each one could probably be its own episode. And maybe that's an idea for the future. But 23 lessons from 23 years as a financial advisor in the wealth management space, watching this business change from a financial product salesperson to a financial advisor with a fiduciary responsibility to do what's in our clients' best interest and help them make decisions as they navigate the complicated scenarios of their wealth. So that's what we want to talk about today. 23, important number for really anybody that played basketball. My generation, the great Michael Jordan, and we can debate this in the comments all you want. Greatest basketball player of all time. I don't even think it's a close second to anyone else. And let me know if that's an opinion you share, but I think we're verging from opinion to fact there. But again, come at me in the comment section when it comes to Michael Jordan being the GOAT. So 23 lessons from 23 years in wealth management space. Here we go. The first, number one, a plan matters more than any single investment. I have seen it time and time again where folks want to invest in something that they think is going to change the trajectory of their financial lives. I'm here to tell you that it probably is not going to, but your plan will. Your plan will keep you disciplined. It will keep you as an anchor to every decision that you make. It will put your values and your goals at the forefront of any investment decision, of any wealth management decision, of any legal decision that you make when it comes to your money. And it's important to have that plan in place first. Full stop. Second, cash flow will beat investment brilliance. It's so funny to think folks think that we have access to better investments, to the best investments, to more insight. And we do our research. We work hard when it comes to our portfolio management. We work hard at dissecting portfolios, understanding what our clients are invested in, understanding how the market could impact that. However, your cash flow discipline will beat investment brilliance all the time. Chasing high return investments will just get you in trouble, and your spending and savings discipline will not. So that's lesson 2. Cash flow discipline will beat investment brilliance all of the time. Number 3, I'm not sure who said it. I'm not sure what. I'm sure it's somebody famous and that I should be giving credit to. I know my friend Drew Boyer says this all the time as well. Time in the market is greater than timing the market. The biggest mistakes come from trying to time the market, sitting on the sidelines too long, making a decision when your gut feels right. Nobody with any consistency predicts when to get in or when to get out of the market. We're heading into the holidays right now. I'm sure you're going to be sitting around the table. You're going to see some uncle, some cousin who said, back in April when the tariffs were, I got out at the exact right time and I got back in exactly when I should. No, they didn't. Because he does it every time, right? We all have that cousin, that uncle, that friend. Nobody does it. Time in the market will beat timing the market all of the time. Tune out the noise, stay in the market, stay invested. That doesn't mean that portfolios shouldn't change or be adapted for changing markets. That means that time in the market is greater than timing the market. Number 4, taxes will quietly erode your wealth more than you realize. Baby boomers are starting to realize this right now as they head into their required minimum distribution phase of their life. If they're not using their IRAs, now they're forced to because taxes are due on this money. Taxes will quietly erode your wealth more than you realize. So will inflation, but taxes are something that you can plan for. Inflation's kind of like the weather. We can try, but listen, tornadoes pop up all the time that we weren't expecting. But taxes, we can do lifetime tax planning. You all should be doing that. You should all be considering not just taxes in 2025. And when you get to February of 2026, most of your accountants are just worried about what you did in 2025. That's what their job is. What did you do in 2025? We need to put that on paper, and then we need to tell the federal government what you did and what you owe. You need to be thinking about 2035 and 2045 and 20 and 30 and 40 years from now, because those taxes will erode your wealth way more than you do realize. Number 5, and this is something that sometimes we say to our clients, diversification works even when it feels like it doesn't. 2022, diversification felt like it didn't work. Everything was correlated. Inflation was rising. Bond yields were going up, so bond prices were dropping as the market was dropping, and it seemed like diversification was not working. There's always going to be something that you wished you owned more of. You're always going to wish you didn't buy something, but diversification is there for when things go wrong. Diversification worked in April of this year. So sometimes it feels like it doesn't. Sometimes it feels like maybe your portfolio is lagging. Sometimes it feels like you're missing out on a hot investment, but diversification works even when it feels like it does not. Number 6, and I will, this should probably be number 1. The area of behavioral finance is taking off in our profession and helping folks understand how much their behaviors matter more even than the investments they pick. But most of the risk in your financial lives is emotional. It is not mathematical. Behavior, fear, greed, impatience, that is what will derail a financial plan. Understand that. Your behaviors matter. And it's tough sometimes. The market can bring out our biggest fears, our biggest sense of greed, but how you respond to those inclinations and your behaviors will matter. And the risk on your financial lives is mostly emotional, not mathematical. Number 7, the right portfolio for you is the one you can stick with. That's it, plain and simple. You can listen to your coworkers, your neighbors talk about what they invested in. It doesn't matter. The one that's best for you is the one you can stick with and the one that is focused on your goals and your lives, not your neighbors or your friends or that uncle that I just mentioned that you're going to see at Christmas dinner. Number 8, and we've watched this and we've helped and tried to help the best we can in a lot of situations, but big financial mistakes usually happen during big life transitions. Marriage, divorce, inheritance, business sale. Those things require some extra guidance for a couple of reasons. One, we just talked about most risks are emotional. Those are highly emotional times of your life. And making decisions about anything, not just money, is risky then. You're maybe not seeing the world with a lot of clarity. You're maybe not in the best headspace or the best frame of mind. and it can cause you to make mistakes. So they require extra guidance. They require a second set of eyes. They require some more insight. Most importantly, and I can't stress this enough, especially working with families when it comes to inheritance, it requires time and patience. Very often we will see, and our profession is very guilty of it, especially because a lot of the firms have sales goals. So they will try to rush a widow or a grieving son or daughter through a process so they can sell another financial product or gain more assets under management. That's probably the process that requires the most time and the most delicate decisions. And be patient through that process. Do not rush through it. I know that sometimes you want to even get it over with, but those big transitions require some kid gloves, and you have to take your time and make sure you're making the decisions with all of the information. That said, number 9, you don't need more financial products. You need more clarity. Most portfolios, a lot of financial lives we see are cluttered. Folks will hoard financial products. They'll come in with 7 different kinds of annuities, 5 different accounts everywhere, and they're very unclear as to what all of this is for. And the product diversification, while it can be important and while it can have an impact, if you're not clear on why you own these things, they don't matter. So being able to put some clarity to your financial situation is way more important than the product that you're going to buy or the portfolio that you're going to use. Making sure your portfolios and your investment decisions revolve around you, your family, your goals, your values is more important than any stock, bond, mutual fund, annuity, life insurance product, whatever it is that's in your portfolio. So making sure you're making those decisions with clarity is so important. Number 10, something else that can be probably debated in the comment section. Nico and I talk about this all the time when we're going through options for our clients and financial plans. Insurance is a tool, not an investment. I can't tell you how many times I've seen insurance products that are about to turn upside down. Insurance products that are about to start running out of cash value because they're sold, they're not used. The process is to buy an insurance policy or for somebody to sell you an insurance policy, again, because they have sales goals, because they have a quota that needs to be met. And it's not revolving around why you may or may not want insurance. Insurance is important. Insurance is the bedrock to a lot of financial plans. Insurance is a necessity, especially life insurance, when it comes to building a financial plan and financial safety. However, using it as an investment can be a mistake. Make sure you understand every nuance of that insurance contract before you engage or sign or start a product, because they can be expensive, they can be detrimental, they can be confusing. Please make sure that you are going through that with open eyes and a fine-tooth comb, because they can be very expensive once you're in them to try to get out. A lot of headlines right now on what happened with Kurt Busch. I'm not going to speculate on what the situation was. I just know that, we're seeing very high profile athletes with teams of lawyers and financial folks, and they are still making the mistake and still getting into a product that they don't fully understand. So make sure you understand that. Make sure it's structured correctly. They can be powerful, they can be useful, but making sure that they are structured correctly is very, very, very important. Number 11, estate planning is not optional. Everything we own has to go to someone when we die. How that happens and how quickly that happens is determined while you're alive. Beneficiary reviews are important, making sure you are leaving clear instructions, making sure your documents are in a safe place and reviewed often is important at every level of wealth. Everything we have has to go to someone else when we die. There is not an option there. The state's more than happy to take it, but I think we would all agree we all pay enough in taxes. So estate planning is not optional. Make sure that you are going through this process and getting your affairs in order well before you think it's time. Number 12, and this is one, again, can be an entire episode, maybe even a two-parter. Retirement is not an age. It is a cash flow problem. You don't retire when you hit 65. You don't retire when Social Security says. You don't retire when your company says. You don't retire when you don't feel like going in anymore. You retire when work becomes optional, when you can afford to not work. It's a cash flow problem, not an age. As soon as we wrap our heads around that, the clarity around when we can retire and when you can retire and when you can start to receive income that makes work optional, it will change your perspective on everything. Retirement is not an age, it is a cash flow problem. Number 13, the biggest risk in retirement is not market volatility. It's longevity. It's inflation, it's taxes over a longer period of time. It's great that we're living longer. I've set the goal to live to 110. But market volatility is not going to be my enemy. It's going to be longevity. Understanding that will help you make better investment decisions. It will help you understand inflation better. It will help you understand the value of that plan. Market volatility stinks, but it's the nature of the beast. It's not going anywhere. 23 years, we've seen some pretty volatile markets, some pretty extreme scenarios, and longevity is still the enemy. Behaviors during those market volatile periods matter, but longevity is the risk that we have to be considering and thinking about. Number 14, your money should reflect your values. Doesn't matter what your values are, but your money should reflect that. For me, signature value in my life is freedom. It's why I own my own firm. It's freedom. And my money reflects that. Some folks value different investment options, like they want to make sure they're investing in things that take care of the environment, or they want to make sure they're investing in companies that are taking care of people. They want to make sure they're avoiding different kinds of investments. But your money should reflect your values. The decisions you're making are important, whether that's I want to enjoy my money when I'm here and I want my last check to bounce. Great, let's figure that out. But your money should reflect your values. The investment decisions you make in the structure of your financial plan should revolve around your values, not your neighbor's values, not a specific investment, but you. Number 15. I've said this time and time again, sometimes on the podcast. I know I say it in the office. I've said it on stage. The best investment returns are often invisible. The best financial decisions are often not financial. Avoiding debt, avoiding panic, our behaviors, avoiding big mistakes, they will compound more than any investment. To me, and this is something to think about if you're young and listening to this, who you pick to marry is a very, very important decision, and it affects your financial lives way more than you think. The best investment decision I've ever made, the best financial impact on my life is who I decided to marry. The best investment decisions are often invisible. Passing on something that you weren't comfortable with, you may not realize the value in that at the time. Having discipline, avoiding urges to go buy the car when your car is just fine, and saving the cash. I'm by no means a strict budget type of financial advisor where you need to only spend what you have to and save everything else. Some people are, because they have different values. I think we're here to enjoy our lives, and money is a resource and a tool to help us do that. We're not meant to just pay bills and save every nickel we can. That said, the best investment returns are invisible. There are behaviors, there are decisions that we make that maybe don't have a dollar sign attached to them. And think about that as you matriculate through your life. Number 16, the 4% rule is just a starting point. That is by no means a plan. 4% rule is easy. You can take your money, go into a calculator, multiply by 4%, and it'll tell you what you can draw down every year, and you should be okay. But that is a starting point. Withdrawals should be dynamic. They should be personalized. They should be catered to whatever your tax situation is. They should be catered to whatever your values are and what your family situation is. That 4% rule is just a starting point. It's a good thing to try to understand when you're young. How much do I have to save so that I can be work optional? It's a great way to give you a starting point on a guide, but it's by no means your plan. And making sure that your plan revolves around your values, around your goals, around your family is way more important than a rule of thumb. Number 17, this may be strange to hear from a financial advisor. Listen, we make our money from charging our clients to help them. Fees matter, but values matter more. Easy for you to say. Fees matter, but value matters more. My staff, my team gets sick and tired of me saying that price is absent in the presence of value. The best analogy I can use is when we take our boys to Disney World. It is not inexpensive. There are traps at every turn to separate me from my cash. But I never leave feeling like I got ripped off because my family enjoyed themselves. I got to spend time with my kids. We all had fun. We all ate good food and had some great time together. And is it important to watch my budget? You better believe it. However, the value of me being with my family at Disney World over those couple of days, value was way more valuable than the dollars that left my wallet. So fees matter. Making sure you're getting value for your fees matter more. Make sure that you're getting what is necessary from your situation, from your advisor, what you're paying in fees. Number 18, I can attest to this because I am one. Business owners need 2 plans, not 1. I'm going to say that again. Business owners, you need 2 plans, not 1. I know being a business owner is challenging. I think it's fun, but we do a lot. We pay both sides of our payroll tax. We do a lot. We also need 2 financial plans. We need one for home, one personal financial plan, and we need a business financial plan, whether it's a business exit and continuity plan. We all probably know what we want to have at home. Not a lot of us think about our business financial plan. And I don't mean our cash flow. I don't mean making sure that we're budgeted correctly and there's money left at the end of the day for us to go home and feed our families. I mean, how are we exiting this business? What happens to this business if something happens to me? Again, went through the thought process this week of realizing my own mortality. Fortunately, again, I have always thought about exiting and what happens to my family and my business if something happens to me. And we've done our best to continue to build a moat around this business to make sure that it is safe and secure and can live on beyond me. Because in addition to my 4 at home, I've got 3 other families that depend on me. I have, hundreds of client households that depend on me. And if I get hit by a bus, their lives are going to go on and they're going to need to go on. And making sure that those plans are in place, it's important. It's our responsibility. It is what we signed up for. And we owe it to ourselves and we owe it to the people that trust us and that rely on us to make sure that we have both of those plans in place. Number 19, I say this to my kids all the time. You show me your friends, I'll show you your future. Your network influences your net worth. High quality mentors, high quality advisors, high quality peers, high quality friends. Making sure you are minding your network is important because you show me your friends, I'll show you your future. I was just with a group of high school seniors at my alma mater at Jeanette High School yesterday. First off, I'm completely blown away. The future's in great hands. I was so impressed with this group of kids, their ability to think beyond themselves, to think into the future. And quite frankly, kudos to their principals and superintendent for recognizing that and giving them opportunities to be in situations where business leaders are coming in to discuss things with them, and prominent members of that alumni base want to come in and they want to have them come in and talk to them and help these kids. And that was one thing I said to them. You all should be on LinkedIn. You all should be finding folks like us who are successful alums from this high school that have the heart to help you, and making sure that network is starting to be woven at the age of 17 is important. You show me your friends, I'll show you your future. Think about that. Think about your network. Think about how you're using that network. Think about how you're giving back to that network also. It's not just What can I take from this network? Financial advisors are always looking for referrals. It's the one thing I remember getting coached on from the day after I got my license. But have you given a referral lately? Have you tried to help both someone in your network and another business by giving a referral lately? So not just taking from that network, but giving back to it is our obligation. It's just as important as tapping into that network when it's necessary for you. Help somebody else find a job. Help somebody else get pointed in the right direction. Help somebody else find a product or service that is necessary. That will come back to you. It always does. Number 20, markets reward patient and they punish impatience. Short-term thinking, it increases stress. I know it increases my stress, especially as we're starting to wind down to the end of the year. And that December 31st deadline seems a long way away on January 1st. And as you hit Thanksgiving, things that need to be done before the end of the year, they start to increase stress. Markets are no different. They reward patience and they punish impatience. It probably sounds very similar to some other points we've made, but be patient. Be mindful of the market. Be mindful of your goals and be patient. Number 21, prepare for recessions before they happen. Have you asked your financial advisor, or have they told you what the plan is if a recession happens? You don't see them coming. There's no siren. There's no alert. They don't break into your regularly scheduled program to tell you that the recession's here. The news will try to bait you into being more scared than you need to be. But listen, recessions are going to happen. We are never going to be immune to them. It's, quite frankly, the sign of a healthy economy, if you ask me. Again, another conversation for another episode. But prepare for them before they happen. Prepare for them at home. If you're a business owner, prepare for them in your business. If you're a financial advisor and you listen to this, prepare for them for your clients. If you are not having this conversation, if your advisor is not asking you or telling you what the plan is, if in fact we start a recession or we're already in one, make sure you ask, what is our plan? Number 22, I can't say this one enough. Probably said that a few times in this episode. Wealth is a team sport. If you want to go fast, go alone. If you want to go far, go together. Somebody else much smarter than me said that. But you need to make sure that you have a team, financial advisor, CPA, an attorney, especially an estate attorney, an insurance specialist. Coordination with all of these saves clients time. It saves you taxes, it saves you mistakes, and it helps correct mistakes if or when they happen. But what I also can tell you is it is impossible to do this at one person. One place, yes. There's a lot of firms that loop all these in. There is no way I could do my clients' taxes and their financial plan and their insurance. I know I'm not smart enough to be an attorney, but making sure that there is coordination between these disciplines is important. So, wealth is a team sport. I love team sports. I love coaching team sports. I love playing team sports. Wealth is no different. I love growing a team at our firm. So making sure there's coordination there, making sure your professionals are all working together, or at least understanding what the other is doing. And it doesn't have to be up to you. That becomes a very dangerous game of telephone. That game always goes the way we expect, right? You tell one person one thing, by the time it gets to the end of the line, it's completely different from where it started. Don't play that game with your money. Make sure they're coordinated. But you don't have to be the linchpin or the bottleneck in making sure that happens. And number 23, the most important lesson. I know that there's songs that say otherwise, but money can buy happiness if it's used intentionally. I just mentioned being at Disney World with my kids. Experiences, relationships, to me, most importantly, freedom, generosity, they all can create lasting fulfillment. I'm not even going to say that stuff doesn't create that. If you enjoy having a high profile, high powered vehicle, a car that you enjoy driving on a Saturday morning through the mountains or through the trails or whatever, go buy the car. That stuff may make you happy. Build it into your financial plan that you want a very expensive car to enjoy on the weekends. I don't even think that stuff doesn't make us happy. It can be. It shouldn't be the main objective, but money can buy happiness if it's used intentionally. It's a tool. It's a tool to help us have options to create the lives we want, to create the giving that we want, to create the lives we want for our kids or our grandkids and our families and our legacy. So I know there's songs. I know that this may be a controversial statement, especially for the last one, but money can buy happiness if it's used intentionally. Think about that. Hopefully you've been able to take something from this. I am going to make a promise that I'm not going to keep adding one to this because we were able to do this in about a half an hour right now, and I'm not planning on going anywhere. So there's not going to be a 50 lessons that takes an hour. I'll make that promise to you as well. But if you have any questions about any of these lessons, please reach out. Hit us up in the comment section. I'm very active on LinkedIn. Always go to our website, hoffmanwealth.com. Find me, email me, call the office, send us a contact request. I'd love to have a conversation about any of these because, for me, I remember when I was considering getting into this profession and, my dad was involved with some of my guidance and said, listen, if you thought you were done learning when you left college, you were sadly mistaken. And he was spot on. It has been a wonderful 23 years. I'm looking forward to the future more than I relish the past. I'm so excited about the direction of our firm. I am so incredibly excited about the folks that I get to go to work with every day, both my team and our clients. I'm excited to see what comes from my kids. If this is a business that they would love to get into, my oldest son, Liam, is starting to toy around with the social media stuff and working with our marketing director, Bryn. I'm just really, really excited. Even though I look back over 23 years with a lot of fondness and a lot of memories and have made a lot of great friends, I am really, really looking forward to the next chapters of this firm, of my career, of my team's career, and my family's lives. So again, as we say on Wealth on the Move, the podcast, keep your wealth moving. Will Hoffman offers investment advice through Private Advisor Group, which is a federally registered investment advisor. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult with the appropriate qualified professional prior to making a decision.